Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, July 5th, 2022. Hope everybody here in the States had a happy and safe 4th of July Independence holiday. And for those of you outside of the States, hope you had a good weekend. U.S. markets were obviously closed yesterday, so we'll have an abbreviated trading week this week, and just wanted to go over the charts. Let's stick with the indexes now. There's some movement in gold today. I'll do a follow-up on that, and crude oil and some other things, but let's just talk the markets. I'm going to try to share my thoughts. Really no change from last week, but we're going to go over, it won't be a long video, but I'm just going to hit on the indexes, where they are right now, where the key levels are, and then just not all, but some of the top sectors in the S&P 500 and just a handful of the market-leading stocks in the S&P and Nasdaq 100. Okay, that's going to paint the picture. I'm going to try to convey my thoughts here as concisely as possible, and I'll just tell you what that is that I believe at this point in time, despite the clearly bearish trend that we've had all year, and we're flirting with new 52-week lows today. Came very close, so you can't argue that. On the flip side, I think the risk reward is it's not great right now. It's probably as good a week as any for an active trader to take off because it is, Independence Day week, with a lot of traders out on vacation. Typically, again, historically, volumes drop. Now they're going to be probably higher this year than most because volume is always higher. If you take a look at the volume since the market's been dropping this year, it's been increasing. That happens during bear markets and correction. Look back at COVID last time before that. Look at any of the big drops, fourth quarter 2018. So when I say that, I'm speaking relative to where it was a couple weeks ago. That's usually what you see. Now, in a big sell-off, volume's going to spike. So there are no absolutes in trading. I'm just trying to tell you that historically, typically this is a lower volume week, and because of that, you tend to have more whipsaws. So take breakouts or breakdowns with a little bit of a grain of salt, or again, just stand aside. Go out and have a day at the beach or barbecue, or just take some time off and watch the charts if you're not keen about trading this week or not sure what to do. With that being said, let's look at big picture here. All right, so most important thing, and again, I've been harping on it now for over 3 weeks. We hit my third target to the button. These were targets laid out well here all the way back when the market topped, and I still think and still maintain that we're going lower. But as I continue to say, support is support until unless broken. So, but let's look at this from a risk-reward perspective. Okay. I'm going to toggle over to SPY and I'll jump right back to QQQ. Let me show you what it gives me a little bit uneasy and why I think the risk reward is not great at this time. Here's my synopsis in a nutshell, what I think. I think the market still has a decent chance to rally, to put in a multi-week or even multi-month rally from around current levels. But I can't rule out and still would put decent odds. I don't want to try to quantify it, but maybe a little less than favorable. Favorable is anything over 50%. Decent would be, close to that area, close to 50-50, and that would be another one more thrust down, which would only be about 5% or so from where we're at. See, this is my weekly chart of SPY, and I've had these, initial targets, near-term target 1, 2 hit, bounce off that. We bounced off both, bounced off the first one, bounced off the second target, and we're kind of in no man's land, and this is what makes me a little uneasy and a little not so confident on any bounce scenario just yet. Certainly still see the possibility of it. I'll get to that in a second, but so we came down here, and remember, the reason I cover multiple indexes, even if I'm not trading those, is because if one index hits, and that's where the buyers step in this case, that low in SPY, although it didn't really hit, at least on this level, I don't see any significant support. There's minor support right there. If you look at this reaction high on this candle back here, and then here, I'll show you with my drawing tool. You had a candle there, you had then we back tested it for a while there, so there's very minor support. There was also a thin zone in the volume price histogram, and that's what we hit. But that was also when QQQ hit very well-defined support, one of my targets. And so we did bounce. So we had the reaction, and we bounced right back to resistance. We had that former second target right there, about 395, was resistance. So As I always say, the initial tag of a target, you look for a bounce back to resistance. Here's the thing: we never hit the S&P 500 never hit this next target, which to me is a much better defined target. It is this reaction high right here after the initial leg up when after the COVID rally, post-COVID rally right there, we'll call it, and then quite a few reactions. So I'm going to measure it for you, and that is from where we're at right now, roughly ballparking it about 5.5% down. And that's pretty good support. Doesn't guarantee that if we drop to that level we're going to bounce. It's just the next first decent support that I have below on the S&P 500. So that would, if hit, give you about a 5% drop. I'm just going to measure it out just in case we blast on through that one. The next support, a long-term second target, is about 9%, and that would be really a golden one where I think that would be it for now when we get a big rally, because that is and has been, I've maintained since before we even rolled over here, that my targets were going to be the what I call the pre-COVID highs, where the market peaked in February of 2020, and so that would give us that level right there on S&P 500, which is about 340. So there it is. So there's what I think is, with a pretty fair degree of confidence, let's just say the maximum amount of downside from this level here. And it's substantial for depending on who you are and how you trade. 10% you might be swinging for the fences. But let's say you think that this whole thing's going to go away soon and the economy's on good footing and we're going to go on a new high. So you have to put everything in perspective. And that's why I try to explain these videos, that what I think is going to happen, I can't guarantee that. How I'm trading shouldn't necessarily be the way you're trading. What you need to do is look at your outlook for the market. I think I do a good job of is identifying key support and resistance levels and chart patterns and things that will trigger the next trend in either direction, up or down. And so I do think if we hit these targets, especially if the charts confirm at the time, I have to say that because it depends on how the 60 minutes and daily charts look, how oversold, overbought, or we'd be oversold at that point. Are there divergences or they're not divergences? Are some of the big market leading stocks breaking support, or are they falling to support at that time? So a lot will go into that. Now, we had a lot of that happen here. So I'm going to maintain right now, continue to tell you where I was last week. I'm erring towards the bullish near-term and intermediate-term bullish outlook. That is, I would put decent but less than favorable odds, less than 50%. I put favorable odds on a rally. It's not high odds, so hopefully you don't take that as waffling. It's it's not an all-in moment for me, but it's where I think we could go there. Nice rally back up to the 200-day moving averages, which on this chart, on a weekly chart, are the 40 weeks. So that would be up to about that 415-ish area, and that would be about a 12% rally. So I do see. I put the odds at more, about 12% up to maybe 5% down, and that gives me, favorable. Skews the risk reward to the long side for me. Now I'm going to jump back there to that QQQ chart, like I said I would. And so you can see here we hit that third target. It was pretty well defined support. It was about 268. Yep, yeah, 268.30 right there is the number. So we'll call it 268ish. And we bounced back up to this right about up to that second target, and we're moving down. And all along I maintained it would be 268 and or this trend line because they come in very close proximity. So let's measure that out now. Let's grab this candle where we're at right now and tell you that if we do take one more thrust down, it'll be a hell of a stop clearing move, a hell of a short seller suck-in move. It'll be a lot of shorts shorting the break of the low, new shorts coming into the game. And that would be, again, depending on if and when we get there, about a 6% drop. So that meshes with SPY hitting that next target that I have, and that would be one more thrust down. Right now, again, the markets can't seem to catch a bid. I've pointed out, which I'll get to in a second, these divergent lows we put in recently on the 60-minute charts, but we've done that before and we got a little rally out of it, which we've had so far, but not too much. We had a little divergent low there, we got a little rally. We had one there, we got a little rally. And these little rallies keep getting sold into. Remember, you put a higher weighting on bullish divergences and bullish chart patterns in a primary bull market. You put a lower weighting. You do have to respect them, and they often play out. They just play out for smaller bounces. All since COVID hit, just about every divergent low on the 60-minute charts we had back here, whenever these were, those were always a catalyst to the next high. And right now, the 60-minute divergent lows, they're catalysts for tradable bounces, but they're just bounces within the larger downtrend. However, we'll get to that one second. We do have positive divergences in some constructive charts on the daily time frame. Remember, 60-minute chart takes a backseat to the daily charts. Those daily charts will supersede what's going on in the 60-minute charts, in my opinion. Here's IWM, had these multiple levels here. And this is support. You can see there was a big old level right there. 1, 2, 3, and then 4 candles and a big old gap, and that's what we hit. It's between my second target and third target. I keep telling you I'm going to take the word potential off because it's an official third target. But again, I'm favoring a bounce before we get there. I think not by by the same amount to be give you slight favorable odds on the QQQ and SPYs to do the same here on IWM. So favorable, and if you want to trade it, trade it. If you don't think it's going the other way, that's fine. Just don't let what could end up being a 20-30% rally eat into what could be very nice profits on shorting or trading this bear market so far on the way down. All right, now we're going to just sidestep down. We're going to look at the daily charts, and no, I'm going to go to the weekly charts. Here's what I'm going to do. I'm just going to go over the top sectors in the S&P 500. Same thing I've been doing last week, but I also want to go over the market-leading stocks as well. And there it is, about 128. That is nice support there. We had a major reaction high there. Tested a few times. We broke out right here. Here, I'll zoom in. Then we back tested all this time. This was months down here. You remember, we're on a weekly chart, so that was pretty much through the end around December. All here from that point down here. So that was about 5+ months of back testing successfully. Then we moved up, and then we set up this trend line right here. And then boom, we finally broke it. That confirmed the sell signals we had back here on the 60-minute charts. We got in this short early. We hit that first target zone there. We bounced. We went down. And this was the next target on XLK. And we're still there. That's my point. Support is support until it's broken. We're slightly below it. That puts us in a precarious position right now. But we've already broke it once and then regained it. So really, this is just this volatility. We're trading around it. These aren't hard levels where if you're at 128.09, it's bullish, and when you're at 128.07, and again, we'll round that off. Let's make it a round number. Make it 128. Oh, there we go. So that's it. So we're close enough right now, and the week is young, but I will say, unless we recover it, it's precarious. And the fact that we already overshot it once, I'm not crazy about this. We overshot it once, we started a rally, and it really, at that point, you had no business breaking it again, and we have. Now, we haven't broken the low yet, but if we do, well, here it is. I'm going to measure it out for you. My next target, or decent, really good support level, is all the way down. It's pretty hefty. It's about a 11.4, we'll call it 11.5% drop, and then there's a trend line a little below that. So that would be if the floodgates break now, or if we have one more thrust down, at least according to XLK, that's how far we can go. Remember, that's just one of many sectors. It is the most important, highest weighted. Here's XLV, healthcare. Healthcare hit really nice support here, about 119, and it's still well above it. And more importantly, I think for XLV, which I'll give it a bullish check mark, 124.63, I have it there, is really good support. It was we broke above it, we traded there, we had a trading range, we finally broke out, we successfully tested it for 3 weeks there, another week there, another week, a few weeks later, boom, 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 boom. We broke it, right? And we broke that trend line. So on face value, that was very bearish, but then we had a very impulsive recovery back above it, and we're back above it now. So as of now, This is a false breakdown, aka bear trap. In that now we're still below the 200s. It's not looking great. Coming off a divergent high. Yes, I do think we're going lower, but can we go higher before we go lower is my thing. And right now, again, let's just take each one at a time. If we want to do it very simple and systematically, we'll give this one the bulls a check here. And on XLK, like I said, as of right now, this moment, but we haven't closed the week solidly above it. XLK was the first one I started with, tech sector. As of this moment, we'll give it a check mark for the bears if we can recover 128 again. We've traded around it so much, you really kind of want to see it just get away, either take out the recent high, last week's candle, or take out the low, and that's where the bulls or the bears. Bulls get a check mark there above the last week's highs. Bears get a check mark below the Friday, week ending Friday, the June 17th. All right, so that's that. XLV I already covered. XLF, here's another one. Again, I'm not going to go through each and every sector, but there's a major reaction high, the pre-COVID highs. When you rallied back there, you tested them, got it rejected, and then boom, a breakout. This is the first back test of that level since the breakout right there of the pre-COVID highs. And now, when I say the first back test, yes, we actually hit it 4 weeks ago right there. But we're trading now right about on it. So this is a drop to it, and it's kind of sloppy trading through there, but that's what happens when you have a very volatile, high volatility like we do right now. You tend to move through these levels a little bit. You gotta give it a little room. You gotta open it up. You can't use very tight stops. So I'm going to give this one, as of now, a check mark because it's in close enough proximity to that support level there. Bull check mark, that is. And again, those check marks can be erased today. One big drop, go back to XLF, won't take much to get it away. We're right here right now at 31.16. We've seen it do this quite a bit. 3% is going to put you below the recent lows, well below the lows, and well below that level right there. So we're at a precarious juncture. That's all I can tell you right now. It's anybody's game. Near term, bulls or bears. There's a pre-COVID highs in XLC. There's a back test of, we've got rejected right there. Rejection, broke out, back tested, and we're below it. And not only we're below it, we broke below it and we rallied back up to it and back tested, and then the seller stepped in and failed. So that was support. Support once broken becomes resistance, and that resistance was validated with 2 weeks, 1, 2, where we tested it from below and could not regain it. So this bears get a check mark right now on XLC on that sector. I'm only going to do a couple more. XLY. There it is. So here's another one. Here's a common theme. This is my takeaway. There's pre-COVID highs. It was my target on, and is on a lot of the indexes, but also a lot of the sectors. And many of those sectors have hit that level. Back tested it, rejection, and boom, successfully tested it right there a few weeks ago, and we're still above it. So bulls get a check mark here. As far as it just at this point in time today, holding support. And so if they can rally it, where do they go? Well, I think they could come up here. Oops, tried to grab an arrow tool. At least 155.57, then the yellow trend line, wherever that is, a little north of that, about 163, and max target would be this downtrend line. You have the 200 days coming in there. So these seem to be like magnets for me, these bounce target zones, and that would be, again, it's meshing with about a 20% rally in this one, in the consumer discretionary sector. XLI, industrials, again, if I'm beating a dead horse here, I'm sorry, this is how I look at things, and these are the most important things I can convey to you right now that I'm seeing. Pre-COVID highs, breakout, back tested for, what is that, a quarter right there, about 3 months, successfully back testing it, rallied up, and this is, again, when I say this, it's a cluster candles, not the first test. Yeah, we came to it and tested it successfully the week of June 17th, successfully the week of June 18th, June 24th, the following week, and the following week after that, July 1st, and here we are again. So again, I continue to repeat it, support is support until unless broken, and if you, I can make a case right now, since I give it favorable odds that we bounce, to be going long right here, right now, because we're at so many sectors at support. It would not be a hard long, but you can do that. It depends on trading. You can go hard long and then just have your stops somewhat below, maybe even relatively tight stops, or what I like to do, a staggered scale out stop where you don't have it all, if it's the market or this sector or whatever you're trading, you have stop 1, stop 2, and stop 3, something like that. All right, so I said I wouldn't do them all, so I'm going to move over now to the market leading stocks, and we will wrap this up. Let's just look at the leaders from QQQ. Then most of these are also the top components in the S&P 500. Here's Apple. And again, I'm just sticking to the weekly time frame now. Apple's certainly in a precarious technical posture. You have the 200-day moving averages up here, or 40-week. We're well below it. That typically denotes bear trends. The only times Apple does a great job, or the 200 days do a great job of acting as support and resistance on Apple during an uptrend. You buy pullbacks to the 200s, it works. Then you short breaks of the 200s. That's what happened when COVID hit. It happened in the fourth quarter. Big Q4 2018 drop. And again, you can see often it comes in, trend line support comes in with those, and that's what happened right here. You have my blue trend line. So by all metrics, I have Apple in a bearish, longer term on the weekly chart, a bearish technical posture. It's just a matter of what happened short term. And I still have some pretty darn aggressive targets. There's those pre-COVID highs for Apple, which I think before all is said and done in this bear market, that's where Apple's going. And I said that back here, and I told you guys that was probably heresy among the Apple bull and just about any stock market bull, thinking, "Oh, Randy, you're smoking crack. Apple's at 181. You think it's going to 82?" I still think there's a lot of people that don't think it is right now, but it probably a lot more than those that believed it back here. So since stock's already fallen about 27, 28%. So you get a stock cut, quarter of its net worth or capitalization wiped out. You start getting some believers, and that's what I like. And I like the fact that everyone was bullish up here, but yet I saw this big, giant, bearish rising wedge. I saw a breakdown, a back test, a failed attempt at a new high there. And now what I'm seeing is a lot of people are finally getting on the bearish bandwagon, and because of that, you're getting a lot of shorts in here, and they're going to get squeezed out, I think. And here's the setup for Apple. As I maintained, all the big fangs. I'm just going to toggle back. We're going to wrap this video up with just a few more stocks, but this is what I've been pointing out for weeks now. We have these divergent lows, positive divergence setting up. I can make a bearish case too, and this is why it's not an all-in moment. This is a bull bear trend indicator, that negative that says negative 1.18 on the PPO. So it's not the zero line that defines a trend, it's that level right there. That's usually when you cross down and you trade below that. I'm talking about the 9 EMA, my signal line, the white line. The trend is bearish, and when the white line is above, the trend is bullish. Be long and strong, right? Fourth quarter of, when COVID hit, that was the last time we were clearly below that level. And so it told you Apple was in a bearish trend, and then shortly after the rally started, it said, hey, guess what? We have a buy signal there. So like I said, you can look at the glass half full, glass empty. I just have to, these divergences are a big part of my trading. So is sentiment, so is everything else, support and resistance, everything I've just covered in this video. So all I'm doing is making the same case I was making last week. Microsoft, daily chart, positive divergence, downtrend line. Just like Apple, they have these downtrend lines. Microsoft had a little false whipsaw there, a little false breakout, but that's because Apple didn't break out. Apple, the biggest, in the group, largest of them all, had a rejection at that trend line. So we're watching these levels. We get these trend lines to break out, and there's Apple, there's Microsoft, here's Alphabet. Alphabet is a little different story. You have big support right here at about 216. That's what you want to watch on Alphabet. It already put in a divergent low, and it already broke out of its trend line. So as of now, this one's ahead of the pack, if you will. And if it can hold that level, what happened, it had a breakout, it started to run, but it's only going to go so far without Apple and Microsoft and Amazon going as well, right? So, but in a positive technical posture. And here's one more thing, guys, I want to mention. Here's the S&P 500. This is what everyone's looking at. The S&P 500 right there, and more importantly, QQQ, in my opinion. QQQ is looking really close, threatening these recent lows, but you have a little bit better outlook right now with Apple. Look at Apple. I should have measured QQQ, but Apple, Microsoft, Alphabet, they're comfortably above. Alphabet's a little weak, but Amazon, they're, as of now, they're all comfortably above their recent lows. Tesla, see this? So you can't write it off yet. If they all break their lows, and then Nvidia, the tech, this is the semis. I told you semis were gonna, one of my favorite shorts on the way down, but I'm long since covered that now. And these are looking nice. Again, everyone's seeing a new 52-week low in Nvidia, but I see a divergent low, and a divergent low that's right at pretty darn good support here. So that's about it. I was just going to go over more of the weekly charts. I think I got through Apple and Microsoft, but there's Alphabet. Over time, again, I see these guys going lower, but they're a lot of them, especially like Amazon. Gotta love it here at this support level. I've been harping on this for weeks. We had one good trade there, nailed the entry there twice. Both times we pulled back to that level and then nailed the exit and then recycled in here. And I'm still holding on to this one, and I'll hold on to it unless these lows get taken out. So just like the rest of the market leaders, you don't just have positive divergence. You have strong positive divergence. There's your first divergent low right there, right, on Amazon, right there. And that divergence has grown even larger with that most recent low right here. And if we happen to punch down anytime soon, we're still going to have positive divergence. These indicators are making such higher highs that we're any other marginal new low. But the thing is, it's also key support. So it's simple stuff, guys. Again, simple stuff. You either do it or don't do it. You buy support. You buy pullbacks, especially market-leading stocks. And I'm seeing these market leaders holding up lately. And I think that's where I think a lot of people are missing. And maybe these market leaders collapse, but I think they seem pretty washed out. Amazon has been trading on this level for a while. Some might see what's a head and shoulders pattern, but guess what? Head and shoulders patterns are topping patterns. They're not bottoming patterns. They're not continuation patterns. So don't read too much into what looks like a perfectly symmetrical head and shoulders, because again, doesn't mean it can't break down. That would be your neckline. I've seen traders use these in all different forms, and if you get enough people to believe in that's what it is, but again, look it up. Inherently, a head and shoulders is a topping pattern. You do have an inverse head and shoulders that looks like this, and those are bottoming patterns, but that's not what that is. But what we do have here is a pretty clean downtrend line, positive divergence, and any marginal new low. And that marginal, by the way, could be that 8% drop that I just talked about in the beginning of the video. So if we get that, and again, to me, it's all about risk reward. So if you wanted to start scaling into longs here, if you haven't done so already, probably not a bad time. And if you want to scale down to that 8, maybe max 11% downside, which I think is maximum right now, in my opinion, whether that proves to be right or wrong, then if you get down there another 11%, and then you do go on to hit the same targets that I've maintained, that would be, let's see, drop 11%. That would put us down here, so it would be a marginal new low. So I'm going to grab there about 97-ish, 97.50, 98, and then the rally up to those 200 days, and where I think Amazon's going to go minimum, it would be about a 38% rally. That's a nice risk-reward ratio. So you can be long here, or scale down to where those indexes could fall to. But if you're holding out and saying, you know what, I like that, I'm just going to wait till they get there, we may not get there because of these divergences. So I'd rather be taking partial positions now, and then room to add, keeping a light long position. And again, there's nothing wrong with just waiting to the breakouts. If you want to be safe, we're in a bear trend, wait till you get breakouts and check marks on Amazon, Apple, Microsoft, everything I just covered. All right, so that's it in 28 minutes or less. I told you I'm not going to go through each and every one of the fangs, but I just wanted to finish up with Tesla again if I didn't already cover that. Big support here, about 624. We had a trend line there. We broke out and we're back testing. And we had at the recent low right here, it was a divergent low. Any one little washout, little capitulation drop this week or next will still give us, just like Amazon, a lot of these other ones I just showed you, it would just give us a again, marginal. Marginal means slightly new low, not a big 20% drop, but a undercut of these lows would keep these divergences intact because these indicators are that much above. They're making much higher lows with prices if prices make a lower low soon, and that would have to happen soon too. Tesla, Nvidia, I already covered. Pepsi, again, I'm going down the components of the Nasdaq 100 in weighting of market cap. So this is, remember, it's a cap weighted index. Pepsi's well above the recent lows right there. Costco next, still well above its recent lows, looking like it might want to break. It's at resistance, but if it can break that resistance, that would be bullish. You could draw a little trend line up there as well. And AstraZeneca. Okay, so I just covered about the top. What is that? 8 or so companies there. Still well above the recent lows right there. Oh, that's what it was. I was pausing because I knew I missed something. Meta I wanted to cover again. Meta on the weekly, I would prefer to see it at support. See, here's my next downside target on the weekly chart. It's not a hard level. It's not super well defined support, but it's all the way down at about 139.24. Don't have divergence, had potential divergence there. We do have RSI divergence there. So while I'm not crazy about the weekly, if I was, I'd be taking a big position. I do like the daily right now. Again, we're in a bear market. Take this with a grain of salt, but that's a big bullish falling wedge pattern with very clear and strong positive divergence. These indicators making much higher lows, right? With prices making lower lows. And see, it's really the problem is, these wedges, they can continue to form and they keep dropping. The wedge gets bigger. Or sometimes they just don't materialize, especially in a bear market. You may not have these divergences play out. I prefer to see a falling wedge at support. So on Meta, for example, on this daily chart, if I turn off all the lines, there's really no support down until this previous reaction low right here. So you can hear it in my voice. I mean, there's some nice setups now, but they're not perfect. Trade them as you want. Don't trade them. If you want to give the trend, the prevailing trend, the benefit of the doubt, hold off to either come to these next support levels that I mentioned in this video, or you break out above the resistance levels overhead, such as the trend lines. And you don't, if Meta's your favorite, I just pointed out, just say for example, do you take Meta on a breakout of this trend line? Not necessarily. You also want to see that 176 resistance go, and more importantly, you also want to see Apple, Microsoft, Alphabet, some or all of those to break resistance as well. Otherwise, you're likely to get a failed breakout if Meta breaks out above here and the rest of the lot, the big market leading fangs don't do it. And then you'll get another leg down, and then you might run at that previous low or the low before that. Like I said, Meta doesn't have great support on the weekly chart or even the daily chart, just that divergence and that potential wedge. All right, that's it, guys. So you have the levels. You know what to watch. There's NQ for you NQ traders. That's hourly chart. We had a little trend line break that happened today. I think earlier today. A little move down, a little flagging action. We're back testing that trend line from below. We are still coming off a divergent low right there, positive divergence, and we're still above it, but it doesn't look great. You would have looked better if we held this trend line today and we didn't break that trend line and we continue to work our way up and we took out these previous highs and we took out this downtrend line. That still can happen, and that's what would be bullish. So previous high in the downtrend line, just replicate this on a 60-minute chart coming off that high. That would be bullish. Otherwise, you broke down here. If you get rejected, pretty big level there, about 11,290-ish. I have it at 11,288.93, so we'll call that 11,289. And then really there's nothing below that other than the previous reaction low that could act as support. But as of now, really, if you look at it this way, going all the way back into the middle of June, this was a divergent low, and we're still above that low. We have what could be the early makings of an uptrend. We just need to do some more work. But if you zoom back far enough, the bigger trend is still bearish, right? We're making lower lows and lower highs. All right, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.